Well, first of all, I don't think Josh is saying that it's safe for buyers at all. And I would say
no, not being safe.
With a forward PE at 18.3 and the rally that we've seen over the last month and a half, this is probably a fragile environment, and it's not something that I would expect to continue, certainly not at this clip. And I would expect the market to give pieces of this back. I think we got a little bit ahead of ourselves, and it's almost like a game of bumper bowling where we're trying to sort of figure out which side of it we're supposed to be on. That said, I'm not as pessimistic as many are for the rest of the year, because I do think that the market is going to react more to inflation coming down and the relaxation in commodity prices than to some of this incoming softening economic data. And the economic data is going to get worse before it gets better. That's how this works. So we need to slow down demand. We need to slow down some of this growth. We're just sitting here hoping to find out that we don't slow it down to a point that turns into a huge contraction. But I really think that that huge contraction risk is more of a 2023 story, not a 2022 story. So as an investor, you want to be present in this market, and I would use down days and minor pullbacks as entry points.
Malcolm, it is without a doubt a tricky environment, meaning it's not necessarily conforming to a lot of, the playbooks that might be out there. And by that I mean, if in fact a recession is not here and is not necessarily imminent in the next few months, and it might be a 2023 event or risk, then the market peaked way too early, right? We normally don't have a one-year lead time between the stock market peak and an inflation and a recession showing up. Now, those are a lot of assumptions baked in there, but how would you think about the interaction of what markets have been saying, how the Fed is maneuvering things, and what it's going to mean for the real economy?
Yeah, I think to your point, the split data that we have everywhere on indicators such as strong job growth and retail spending, for example, versus rising interest rates and layoffs and the housing market cooling makes it really tough to look at anything in history and say historically we know that when the market does this, then 12 months later it means it's going to do that. Or we know historically that when bond yields do this, then it means that the stock market is going to do that. And so it makes it really tough to point in any direction and say this is absolutely what we're headed for because we've seen this play out before. And so I think to the point that Josh made and then Liz made too, it's not going to be super terrible or super great in either direction in the shorter term. And so it's more a function of making sure that what your expectations are in line with reality, which is, we're not off to the races here. We can't confidently say we've hit peak inflation and it's time to everybody crowd back into the space. But it's also not the time to necessarily get super pessimistic and say I'm selling out of the S&P completely because I know for a fact it's going back down to 32, 35, and I'll pick it back up from there. So it's really a function of staying disciplined and staying invested, knowing that the market is going to eventually work itself out, and 2023 will probably be a little more clear picture. But we just have to get through this bump with the Fed deciding how much more aggressive to continue to be.
Josh, just to look for more apparent paradoxes in this market, or at least mixed signals, we have utilities having made a new high and relative high. So they're kind of leadership somehow within this market that is also seeing an echo bubble in some of the meme stocks and some of the lower quality, heavily shorted names flying. Is there a way to reconcile those things, or just markets do funny stuff?
I think markets do funny stuff is a great answer, and I rely on it all the time in conversation. But the meme stocks are tiny. You're talking about non-S&P 500 stocks. There's really not a lot of institutional money in there. There's very aggressive trading going on, but there's not enough sponsorship where you could say something thematically is driving big money to be doing trades like that. I think we all understand what that story is. Utilities is different. Nobody's having fun trading utilities. That's meaningful money with gravitas behind the people pushing the buy and sell buttons. And so I would say that signal is a little bit heavier. Let me give you a couple of more. Pfizer and Merck. These are two of the best trading setups in all of large cap U.S. stocks. These stocks are about to substantially break out, and they have been setting up. This has been setting up for a long time. Why would utilities be leading, and would some of the best setups in large cap stocks be in large cap pharma? I think we all know the answer. I think the market is voting that way. Doesn't mean they'll be right, but use that. If you want a sentiment gauge, use that. Don't use Bed Bath & Beyond.